Is the Fed finally about to admit that its easy money policies are leading to out-of-control inflation? Will consumers be able to even afford these higher prices without further government stimulus? And why are Treasury yields falling despite a really hot CPI print? Answer those questions and more on today's macro show. Now, I want to go back to last week just for a moment, because remember we talked about how the Fed was just starting to mention this tapering thing, but it didn't really seem like they were really convicted about their views. 1 week later, due to the CPI print for June, which we're going to look at in a moment, all of a sudden the narrative has changed. And I want you to see this because there's one person that really matters, and that's Fed Chair Powell. We're also going to look at what he said today as well. Let's start out with the CPI, which came in really hot at 5.3%. Now remember, this is everything all in, food and energy. This thing is off the charts. In fact, the last time we saw the CPI up this high, you have to go to the middle of the great financial crisis. Now perhaps that is foretelling what is about to come. And that would be very interesting if we do see a replay in this. And for those of you that are Real Vision subscribers, check out my recent conversation with Real Vision President Travis Kimmel, where we talked about how the great financial crisis is likely to have a complete replay. And you can see it here with the consumer price index. In fact, it's not until like September of 2005 that you can see anything even close to that. So this is off the charts. But it's not just a story of food and energy, because if you take those out, the core CPI is way off the charts. Look at that, 4.5% year-over-year rate of change. Last time we were even close to that, well, you've got to go back to the early 90s of all places to find it. So it seems pretty obvious the Fed has a serious problem. And are they about to raise the white flag and say, look, we admit it, we've been too loose with our policies. It's time to scale this back in a big way because consumers are going to be in big trouble if we don't. Well, let's go back now and look at what the head of the San Francisco Fed, Mary Daly, had to say this week. Because remember last week, she was kind of like, yeah, we should talk about this, but I don't think it's going to happen. Look at how her story has changed now that we see these big inflation prints. So Fed's Mary Daly says tapering of bond purchases may start this year, courtesy of CNBC. Let's go down here and find out what she had to say. And she said, we don't have an exact timeline, but the time is drawing near. Here, quote, it is appropriate to start talking about tapering asset purchases. Well, we know they've already started that conversation, taking some of the accommodation that we have been providing to the economy down. We're still in a very accommodative position. Yeah, you think with $120.5 billion a month? Yes, and over $800 billion in reverse repo day? Yes, you're very accommodative. With a low funds rate, yeah, so if you think the low federal funds rate is the issue, there's much bigger things to look at. But we don't need all the tools we see the economy get its own footing. So what she's simply saying is, look, the economy's starting to recover. We don't need to do all this. And then she goes on to say this is absolutely the time to start doing that, not tapering. As she goes on to say, having those conversations. My own view. Now, mind you, this is very key. Her own view, not the view of the FOMC. Her own view is we'll probably be in a good position to taper at the end of this year or early next. And we're going to discuss why that's probably, why there is an equal chance on both sides for that to happen. And I'm going to give you the reasons why, but let's go through a little bit. We got to go a little bit further in this story first. All right, so let's see. And she ends her conversation with CNBC by saying right now, referring to inflation, remains steady in the boat. Don't read too much signal out of any month of data, and let's get through this volatile period so we can really see where the economy is. So what is that? What is she telling you there is, look, we still think this is transitory. That's what she's really telling you. We still think this is transitory, and it might not be, but we need to let the data do its talking. We have to remember the consumer price index is one of the most lagged data series the Fed uses. So they're always looking behind them to see what's going on. So that's why you don't see the Fed react right away. They want to give it time to make sure that the wheels are digging in and getting traction, and this is a real deal. But let's go on because there's more from some Fed speakers here. And we'll go to, I didn't bother pulling the whole interview up, but this is from M&I Market News, who interviewed the Dallas Fed Chief Kaplan, and he says, tapering sooner gives more flexibility and does not tie the Fed to earlier interest rates hikes. Well, that's perfectly true. If the Fed was going to start raising rates or tightening monetary policy, you would do it by tapering the balance sheet first, and you would then last raise the federal funds rate. So all he's saying is, yeah, we kind of got to do this because we have no margin for error. And we've talked about on the show how the Fed is on the knife's edge here. They have no room to move. If the economy rolls over and back into recession, there's only one thing they can do, and that's going to be more QE. And you can guess where they're going to do it. Are they going to do it at the front end of the curve, the middle, or the long end? If you said front end, no, because the bank's already convinced them not to do it. They're going to do it at the long end of the curve and drive the long bond through the moon and long rates down near zero. They have no latitude on this. So Kaplan is right. But now today, Fed Chair Jerome Powell sits in front of Congress to do his testimony. Let's see what he has to say, because really he's the big boss. And when you look at the Fed, there's a Fed chief, then you have voting members, and you have non-voting members. The non-voting members can say anything they want, and they don't matter. The voting members matter, but a majority of them do exactly what the Fed chief wants. Whoever's sitting in that seat has the most power. Let's see what he has to say to Congress, because remember, his job is coming up in February. We're going to talk about that in a moment. Let's take a look at what's going on here with his testimony to Congress. Now, we're not going to see anything new here, but the setup of his job coming to an end in February is a big deal. And so in his written piece to Congress, he says, as always, in assessing the appropriate stance of monetary policy, we will continue to monitor the implications of incoming information for the economic outlook and would be prepared to adjust the stance of monetary policy as appropriate if we saw signs that the path of inflation or longer-term inflation expectations were moving materially and persistently beyond levels consistent with our goal. So he's just saying, hey, look, we stand ready to make a change. Now, he goes on to say, in addition, we're continuing to increase our holdings of Treasury securities and agency mortgage-backed securities, at least at their current pace, until substantial, notably, this word substantial has not left, substantial further progress. So if he took the word substantial out and said until further progress or a bit more progress, you would think they're close. But substantial, he's telling you, we're not anywhere near where we need to be. So substantial further progress has been made toward our maximum employment, which we know there are about 8 to 9 million people short of, and price stability, which is a joke in itself. These purchases have materially eased financial conditions, although they're starting to tighten. He didn't say that. I'll add that. They're starting to tighten, and are providing substantial support to the economy. At our June meeting, now here's the key as we get into the taper. At our June meeting, the committee discussed the economy's progress toward our goals since we adopted our asset purchase guidance last December. While reaching the standard of, here we go, substantial further progress is still a ways off. So he's reiterating, look, if you think we're close, we're not. Participants expect that progress will continue. So all he's saying here is, look, we're on a good path, but we're nowhere near as much as the market thinks we are. We will continue these discussions in coming meetings. So now he's openly stating that, yes, we're going to continue having talks about potentially tapering, which is fine. As we have said, we will provide advance notice before announcing any decision to make any changes to our purchases. Now, why does this really get interesting here? Because Powell's term is up in February. Now, it should be well known that Powell is a Republican and that President Biden is a Democrat. Now, unlike when former President Trump was president, he had a lot of issues with Fed Chair Powell toward the end of his term. And you'll notice there has been zero comments from President Biden or the Biden administration, or particularly any negative comments, let alone any real comments about Fed Chair Powell. Now, this is important to understand because the Fed is supposed to be apolitical, even though we know they're not really. But you have to look at it from the president's view. Now, normally when a new president comes into office, they want to bring in their own people. Makes sense. But the Fed is a little bit different. You can't just remove a Fed chair because you feel like it, even though you can, because there's a problem with that. The market may not like it. And so as long as Fed Chair Powell gives the market what he wants, he stands a very good job of getting his position back. And of course, Congress ultimately is the final decision on that. President Biden would nominate him, and then Congress would confirm it. That's how it goes. So if you were him, what would you do knowing that your job's coming up in February and you're one of the most powerful people in the world? Well, are you going to do something radical that could be assigned with the economy rolling over? Because you imagine, what if the Fed did start tapering, the economy rolled over anyways? Who's going to take the blame? Now, let's assume that President Biden decides to unseat Fed Chair Powell. Now, if he does, Powell will know in advance. This will not be oh, by the way, tomorrow you're done and we got someone new. We'll know ahead of time that Powell is on his way out. So he will have a unique opportunity before he goes to taper, to hand off to the next Fed chair the process of the tapering. So he's got a pretty good position here. If he stays seated, he can just say, look, we're not going to taper, we're not going to do any of this stuff, but we're talking about it. And if they pull him out, well, he's got an ace in his pocket that he can play and kind of dig it to the Biden administration if he so chooses to. So if you look at the big picture, is the Fed going to talk the taper talk? Yes. And why do they have to do it? Because the markets are telling them they need to. And so they're giving the markets what they want. That's what the Fed does, is they give the markets what they want. Now, let's get into the data here, because there's some interesting things we want to cover there before we talk about if the consumer can even afford this, and is this inflation really going to be transitory? Where is it coming from, and is it going to last? Is the Fed going to be right by just waiting this out? Well, let's dig into the data a little bit more and see what we can find. Let's go back to Tuesday and start looking at inflation around the world. We can go to Germany, and what do we see? The Germany CPI month over month from 0.5 down to 0.4. So coming now into more moderate range, slightly disinflationary. And look at the year over year, went from 2.5 to 2.3. So again, slightly deflationary, still pretty big year over year rate of change, but we're seeing it cool off there. Now we'll head over to France. Look at the month over month, went from 0.3 to 0.1. Now 0.1 month over month inflationary, hardly at all. So that is a disinflationary move, and now sitting at a very low rate. Look at the year over year CBI, went from 1.4 to 1.5, slightly inflationary, but not that much. So indicating that inflation in the Eurozone is starting to cool off, which would again suggest inflation in the US will at some point too. We'll move down into the National Federation of Independent Businesses. Small businesses are more optimistic, and you might kind of wonder why that is. And the reason is simple. They're getting ready to raise their prices, and they're talking about it. And there's nothing that makes a business owner more optimistic than being able to either cover their expenses due to higher employment costs or higher goods and services costs, or to make more money. So they're a bit more optimistic that they can pass those prices on to you. Now let's move into the CBI data. We already started a brief look at the graph. Month over month, 0.9%. That is a huge month over month print, and bringing the year over year to 5.4 as we've looked at. Let's go into the BLS data and see what we find here. And you can see the big moves in the CBI are in used cars and trucks, 10% increase. That's huge, 45% year over year. Now you have to ask yourself, is that really sustainable? No. Hotels and motels, prices were up there. We can see that in transportation services, and as well as car rentals, airlines. Those are your top four, and then appliances. Now, if you can look here at energy, you can see that's up 24% year over year. Is that sustainable? No. Is gasoline going to continue to rise at 50% per year? Look, I'm sure the oil companies would like that, but that's not realistic. And is pipe gas service going to continue at 15% annualized? Unlikely to see that either. Now, what's odd, maybe odd, is medical care went down 2.2%. So what you're seeing here in the CPI data is really interesting, because 10% of the CPI, the highest 9 categories of all things, contributed to most of the increase. If you strip out the top 10% of the CPI, instead of growing at 0.9% on the core CPI, it grew at 0.2. That's what the Fed is seeing. They're saying, look, there's some outlying things going on here, and this is likely unsustainable, that 10% of the CPI isn't going to pull the whole thing up. Now, some people may be thinking, well, it'll just rotate through the CPI. It could. But the Fed's saying, look, 90% of the CPI was up 0.2% on the core. Not inflationary, not sustainable inflationary. Now let's go back and take a look at our charts from our buddy Julian Biddle and see if he nailed it, and he was right on the money. We have the percentage change year over year of the CPI versus the ISM manufacturing prices paid, predicting it would go higher. It did, but even more importantly, his internal headline CPI versus, the headline CPI versus his trend indicator, he said it was headed up near 5.7. It's at 5.4, still could get there, or it's 5.3. So good job to Julian for calling that. And I, again, appreciate the charts from him. So core CPI, as we mentioned, up 0.9%, would have been up 0.2 if you strip out the top 10% of the CPI, driving those numbers higher. The year over year, whopping 4.5. But what caused the market to kind of say, nah, this is not going to hold? Well, that's real earnings. And when you see real, anywhere you see real, it's called inflation adjusted earnings. So you would, in this case, you would take earnings and you would subtract inflation from it, and it went to 0.9. Now, this is a problem because you see here, again, going back to the BLS, real average hourly earnings for all employees decreased 0.5% from May to June. This is a multi-month trend now, seasonally adjusted. And this result stems from an increase of 0.3% in the average hourly earnings, combined with an increase of 0.9% in the consumer price index for all urban consumers. Real average weekly earnings decreased 0.9% over the month due to the change in real average hourly earnings, combined with a decrease of 0.3% in the average work week. So what we're seeing from the BLS here is saying, look, prices are going up and people have less money to afford them. Now, if you think about creating sustainable inflation, you need to be able to afford those higher prices. Because if people can't afford higher prices, then stuff gets stuck on the shelves. And if you're selling things, if you're a retailer or a wholesaler and your inventory is backing up and you can't sell it, you're not going to sit there and say, well, I'll just wait till people pay my price. Meanwhile, I'm just not going to be able to pay my rent, feed my kids, or pay my car payment or any of that stuff. No, at some point, lower your prices. So I did a chart because I can't find real earnings on the Fed database. So what I did is I took the average hourly earnings and subtracted the year-over-year CPI. And let me show you, this is really interesting to me. And you can see that generally, your real wages just kind of keep pace with inflation. Some months it's better, some months it's not, but you can see it just kind of follows a trend line there, and that makes a lot of sense. And then we go into the pandemic, and boom, why did this shoot higher? Due to government stimulus. And then when the stimulus ran out, crashed down. And then it came back up as we got more stimulus, and now look at what's happening here. It broke the trend line, it bounced up, and it's still below the trend line, falling lower. And what this is telling you is exactly what I've been saying is consumers can't afford higher prices. They will get rejected. In fact, you can go back to the great financial crisis and you see something kind of similar that, hey, consumers couldn't afford those higher prices. In fact, if we pull the Chicago Fed National Activity Index data, you can see that when we go back and we see the national activity declined, the same time the inflation-adjusted earnings did, then it bounced up. So what is it telling you for the national activity of what's going on with the national economy here? It's telling you the national economy is going to slow down. And then if you look at the Cleveland Fed median CPI, which we looked at before, it's stuck at 0.2%. So even the Cleveland Fed, who takes the 1 month inflation rate of the component whose expenditure weight is in the 50th percentile price changes, is saying, look, this isn't broad-based inflation. This is only in certain sectors. This is why you're hearing the Fed take a step back and trying to drag this out, because they're not convinced. The data is not convincing that we see real inflation. We're seeing it only in certain areas. All right, now let's go on to we got to talk about yields. We got Treasury auctions. Now, some of you may remember from yesterday that the 10-year Treasury auction, we got some more economic data. You know what, let's quickly run through that. I think we've got, Great Britain definitely seeing some inflation month over month, 0.5. That's still fairly hot. You don't really want to see that. Year over year, up 2.5% from 2.1. Their core CPI is still up 0.5 year over year, 2.3. So excluding food and energy, things are running hot there. How about today? Look at mortgages. This is interesting. Mortgage applications up 16%. Refinances were up 20. Now, why would refinance applications be up 20%? Is it because rates are so low that people are like, man, I need to go refi again? No, the decline in real earnings is telling you Americans don't have as much money. And maybe this is why we're seeing credit card usage go up. Some people say, wow, look at credit cards. People are out spending like crazy. Maybe they don't have the money they used to, so they got to charge it. And where's one place that Americans have a lot of equity right now? Is sitting in their homes, and the banks are willing to let them extract it. Potential danger sign again. I know you're like, man, it seems like the great financial crisis coming in. People are going to pull, ATM out, use their homes as ATMs. Yeah, not what you would expect, because people are short dollars. That is the big part of the thesis here. Looking at the U.S. data, producer price index up 1%. That's a big number. Year over year, this is coming out of the factory prices up 7.3, kind of validates what we're seeing in the ISM data. Core, excluding food and energy, up 1%. Year over year, up 5.6. How about crude oil inventories down 7.9 million, which is phenomenal. You think crude would rally on that? No, it sold off. Gasoline inventories up 1 million. Even though expectations were down, we're expecting a minus 1.8 million, and distillate stocks up a whopping 3.6. Here's the thing: crude oil inventories are well below their 5-year average, not a major issue, and distillate and gasoline inventories aren't. They're right around. I think they're slightly below their 5-year averages. There's nothing about this that's really bad to suggest that we see a sell-off in oil, unless perhaps the market is starting to figure out consumers aren't going to be able to afford it. Now, we saw this week on the 30-year auction, bond prices sell off, interest rates rise. And it was kind of interesting because when you look at the Treasury auctions, there was really nothing terrible about it. The yield was a little bit higher than the market thought. At the time the auction went through, yields were just below 2%, and then they priced out the auction at 2%, so all of a sudden sellers came in. If you look at what foreign bidders took and domestic bidders and dealers took, nothing major there. In fact, if you zero in on the primary dealers, the Fed is still buying more than the dealers are getting at the auction every month. So that you think would still be a positive. What the market didn't like is the bid to cover was below its 6-month average. Not super below, but that was what did it. Gave the sellers a reason to come out. So why are Treasury yields rising despite a fall in consumer prices? Why are Treasury yields falling despite a rise in consumer prices? And that is simple. We're going to go to TLT here, the largest traded long-term U.S. Treasury bond ETF. Here you're seeing now, if you don't watch the Sunday night chart show, this is going to be kind of unfamiliar to you. But if you do, we look at volume profile. Volume profile here on this red line shows we're looking at a 10-day chart where most of the shares have traded in the last 10 days. And what it's telling you is prices got slammed down here. You can see right here, this was post-auction. Oddly enough, the CPI report comes out and bond prices went up. You would have thought that surely it would go down. Then the auction comes out and sellers just hammer this down. And all of a sudden, prices start rising in the overnight and the spring higher today. And what is that telling you? What is a volume price telling you? Is this cluster of volume here is buyers. And so when prices got slammed down, they went up because those buyers are still buying, and they're buying price back up, telling you that interest rates are indeed going to head lower. And that is telling us one really important thing from a macro perspective, and that is that financial conditions are tightening. Perhaps we're seeing that in real average earnings, and that could be why we saw oil dip today. Anyways, thanks for being fans. Thanks for liking. Thanks for subscribing. We'll be back on Friday for the macro show. I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video is provided as educational information only. Is not intended to provide investor or other advice. Materials not to be construed as recognition or solicitation by a security, financial instrument, or to participate in particular trading strategies. This video was prepared by Steven Van Metre, Mo personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advice Inc. or Steven Van Metre Financial.